Today's episode of Market Talk is brought to you in part by GrowMark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Friday, August 20th. I'm your host, Jesse Allen. Great to be here with you as always as we are continuing our week-long road trip. We're in our Iowa studio here today as we are set for the show and ready to talk about a lot of things going on in the market trade. We thank you for joining us. Find us online, markettalkag.com. That's our home on the web. markettalkag.com is where you can find all of our streaming sources, social media links, and more. Well, joining us here on this Friday, normally we talk to him on a Wednesday. We had some changes in the schedule this week, and lucky to have him in on a Friday afternoon. Mike Zuzolo with Global Commodity Analytics joins us. And Mike, great to catch up with you, sir. And I think the last couple of days, traders are probably just kind of happy the weekend is here with that broad sell-off in the market, and that spilled over again into Friday's trade, Mike.
Yeah, while you were introducing me, Jesse, I was thinking probably some of the viewers were thinking, "Oh, I bet it's Zuzolo because the market was down hard," and so we keep with the trend. The trend is your friend. The bearish price action is thanks to me. Thank you very much. Big footprint, big Sasquatch footprint, I'll call it, of the macro markets hitting, and this is what we saw this week for the most part. I think maybe Friday we changed it up a little bit on some supply and demand fundamentals, but three things I think really knocked us down hard and made us to the point where the dollar index jumped to its highest level since November of 2020. So we're getting up there in the dollar index. But the biggest thing, I'll start off with the number one thing. I think it was the COVID and the Delta variant. Goldman Sachs came out Wednesday, Thursday, and cut their third quarter GDP for the United States from about 9% to 5.5%, Jesse. I don't think I've ever seen a cut of that magnitude in the quarter you're in. And so that took their full year GDP growth down almost 0.5% to 6%. That was almost solely on COVID, the Delta variant. That booster shot, I think, shocked the market that we're not going to get out of this as quickly as we wanted to. This is all familiar territory for what you and I have been talking about. But I think it had a lot more traction to it this past week because of the fact that we saw that come together with the geopolitical uncertainty of what was happening in Afghanistan. That attracted a safe haven buy into the dollar and the bonds for a time period. And then the third thing I think that really came in and kind of solidified the idea of let's get out of some longs if we're in assets was the Federal Reserve minutes. Those came out, and if you read in between the lines, I felt as though they were maybe having a little more dissension and disagreement with one another about when to taper, and not if we taper, but when to taper or when to reduce monetary policy. So I think these things all came in almost the exact same time, and you saw it in the equities markets, and you saw the globalization commodities. As of Friday morning, the number one leader to the downside for the week was unleaded, followed by crude, followed by copper, followed by soybeans. And so those are your globalization commodities, generally speaking.
Well, I know we were chatting a little bit before we jumped on air. You mentioned to me, and I'm just seeing it as well, some news coming from the EPA as well, and that seemed to fuel into the markets on Friday too, if you want to talk about that a little bit.
Yeah, it's early days in this because we don't know a lot. Reuters broke exclusively a letter that is supposedly being generated out of EPA going to the White House. As I read it, suggesting to the White House that we cut back on the biofuel blending to essentially go back towards COVID levels, which is very strange in my mind if it's correct, because we've already outpaced the COVID levels and gotten back to pre-COVID levels for gasoline consumption. So I think if I read it the same way the market read it, it helps explain why the soybean oil was limit down in the December contract and the corn took out its July lows of 536 and 3/4. That was kind of the Custer line, and the Custer stand for the grain markets as a whole, especially the corn and beans, was at 536 and 3/4 level in corn, because beans had already been kind of technically destroyed for the month by taking out its July lows back on Thursday. Good news is that the corn was able to get back up above that level on Friday's close. So we preserved by the hair of our chinny chin chin the technicals on the corn market, and wheat actually still looks pretty decent, even though it kind of joined up with the corn and beans in the later part of the week. But it actually still looks okay on the weekly and monthly charts, if you ask me.
Well, you mentioned some of the technical damage that we did to the charts here towards the end of this week, and I know we've had narrowing trading ranges in corn and beans, especially here lately. But we've been testing some of those lows, breaking through some of them, some of those moving averages. What are your thoughts on where we end up this week, and if there is room for some downside potential here, just with some of the chart damage that we have done or come close to doing, Mike?
Yeah, that's a really good question. It's a really tough one because we have done some chart damage. We've done some chart damage on the commodity indexes that I keep track of, especially the agriculture commodity indexes. And as of Friday's close, we were still making new lows in the crude oil market. And I think copper and crude oil and soybeans, to a lesser degree, really got to show that they're done going down, that we've exhausted the liquidation by the funds. And, I think we talked about this either the week before last or last week, Jesse, that I was worried that the macro forces would come in here and we'd have a hard hit because of this wedging pattern that you're talking about, this kind of forming of a wedge or a triangle where you had higher lows and higher highs, higher lows and lower highs, and it kept getting narrower and narrower, as you say. And so that tends to suggest that you're going to have a really harsh move one way or the other. But it should also be relatively quick in terms of its time duration. So what I'm going to talk about this weekend with clients and subscribers is the idea that one of the key indexes that I keep track of is a agriculture index. It did break some support levels. It did take out its July low. So there's anywhere from 3 to 8% more downside for the next support level to be tested in that chart. When I looked at the bean oil on the close, it also had its next support level at about 8% lower than where we're at right now. I think that's the top end of the downside, but a couple 3% more downside would not surprise me in light of the pro farmer numbers and in light of some of the rains that are coming through, much needed rains in Nebraska especially, and to a lesser degree some of the Dakotas and Minnesota as well.
You brought up the Pro Farmer Tour, and I was going to mention that as well. And really, to me, and I think to the entire trade, there wasn't anything surprising that came out of that tour to really move these markets one way or another. I think the market came into the week hoping to have something be like, okay, here's our sign to go one way or another, and it just didn't happen. We kind of just almost seemingly confirmed what USDA has been saying in crop progress reports, et cetera.
Yeah, I couldn't agree more. I think the one thing that I think was a little bit of a surprise was their increase of the harvested acres by 910,000. But Jesse, I always look at Pro Farmer in their ranges. I really don't look at the headline yield number. I look at their ranges because it's August and they don't go in the southern part of the Corn Belt and they skip North Dakota. North Dakota's big this year for soybeans. And so I feel like the ranges are what counts. And I liked where they were on their ranges. I mean, I'm on the low end of a 175.2 yield that they gave us for corn. I'm on the low end of that range. I don't go all the way up to 178.8 like they do. And I would say maybe a little bit of a difference for me, again, because of North Dakota and some of the southern states that they don't go through that are really big bean producers, is they came at the low end of about 50.2 on beans. I feel like I'm closer to 49 bushels. I actually am probably a full bushel below them right now. And that's because the drought monitor came out again with the agriculture and drought attached to it. Soybeans went up a percentage point in drought again this week. We're still sitting at about 31% soybeans in drought in this country. We were at 14% last year at this time. And then the crop conditions, we continue to see those just steadily decline. And I think we're getting a little bit too late in the year to really put on a lot more pods. And we're getting very close to the time period where I think it's going to be hard to fill out pods, especially in the Western Corn Belt. So we had crop conditions drop to 57% good to excellent. A year ago, we were at 72%. So these are numbers that made me think we're pretty much below a 49 bushel yield at this stage of the game. The only other thing I'll throw out is maybe you'll give me an idea because you were in the Dakotas this week. When I saw the pictures of Pro Farmer corn in the Western Corn Belt and I compared them to mine, they were very similar. A lot of dent, not a lot of life left in that corn to be able to add test weight or fill out the tip back. And in fact, we could lose some test weight if we stayed hot and dry.
I would agree with that sentiment, and that was something I saw as well. A lot of dent, a lot of tip back, and I don't think that the rains coming through here this weekend are going to be enough to really add much test weight in corn. Maybe a shot in soybeans. I heard a lot of farmers talking about that in soybeans here this last week in the Dakotas, that maybe that northwestern corn belt, soybeans could benefit from some rain, but corn definitely not. They're pretty much shut down. It's done. It is what it is. And you know, you look at some of those fields and, you know, you get the windshield view. It might look great from the road. It's not so great when you get out there, or vice versa. It might look bad from the road, and then you get out there and it's great. So it's really variability is the huge thing, Mike. That's what I've heard from farmers all week long, and I'm sure that's what you've been hearing as well.
Yeah, and I think the variability is the buzzword, is the key word to use, and that really kind of suggests to me that we could get above average, but not much above average. And I think that's where 49 bushels is still a heck of a good national bean yield when it comes right down to it. And 50 obviously is what we're shooting for every year, but 49 is not bad. You know, if you get down around 45, 44, then you can start talking about tragedy like a 2007 or a 1990, a 1988 type crop or something like that. But, you know, this is where, again, reiterating the North Dakota story, I remember one of our colleagues up in North Dakota told me not long ago that one county in North Dakota for soybeans is, I think, either number one county or number two county for production in the whole United States. And I've never double checked that, but that's pretty amazing when you think about that's how key North Dakota is when it comes to our soybean production. And that's going to be really important. If they're really short on beans, that essentially dries up your Pacific Northwest market. And that then creates an environment where we're going to have to ship a lot more out of the Gulf. And I'll tail end what I just said with something I think is very important here. And this goes back to the Goldman Sachs, the supply chain, and COVID. We've got a major port in China that's down right now, and they're not getting boats unloaded. Container ships are out in the water. This supply chain is creating higher costs, and there's no two ways about it. And I think that's part of the reason why we've lost some value in the cash corn and bean market at the export side of the equation. Even though we've got a shorter crop potentially being grown here, the end users are not running to get stuff locked up right now because they don't have the ability to ship it out. So they're back to just-in-time buying. And I think this explains a lot of the past 3 weeks why the cash market hasn't really been able to kick it into gear. And it helps explain why Goldman Sachs moved the way they did.
So, Mike, to kind of bookend our conversation in grains here and wrap it, you know, we're losing some of that value in cash. We're obviously watching the futures turn downward here at the end of this week, maybe looking at some harvest time lows possibly coming in here. I mean, I'm just throwing that thought out there. But if I'm a producer and I got to revisit my marketing, I'm looking to maybe lock some floors in. I haven't done that this summer like I should have. I mean, what do I do right now? What is the best advice, whether we're talking corn, beans, or even wheat for that matter? I think we can kind of blanket all three fairly closely with the same general thought, I would think.
There's a couple of good reasons why I believe that buy and puts are still the right way to go, Jesse. We don't have the time to talk about it here, but I will say briefly, the volatility on these options has really collapsed in the last 3 weeks, and that is a buyer options friend. Buy low, sell high. You do that with the option volatility, just like you do with the flat price. And I think the other thing I'd say, the reason I'm not eager to sell a lot of cash here and buy back into the futures market is because I still feel like the September delivery could create some fireworks in beans and in corn, and that the September cash price, especially as we passed August 31st and get into the actual delivery process, maybe that cash market can start to kick into a higher gear again, and the cash leads the market higher. So those are kind of the things I'm looking at going into the next 10 days is if I lose technical support, get the puts bought, don't sell cash, and then look where we're at on September 10th, September 12th.
I want to flip over to livestock, Mike. We need to talk about that today. Probably the one shining star of Friday. Hogs let us higher. Cattle finally pulled along as we went through the day there, Mike. Let maybe start with this hog market a little bit as we kind of rebounded off Thursday's selling and found some strength again. What are your thoughts as we wrap the week?
Yeah, the big thing about the hogs I thought about was the soybeans and the pork and bean trade until Friday, and then they divorced themselves, and that was probably the best thing to see was the equities markets and the livestock markets on Friday really came in and said we're not going down anymore, and the funds didn't want to press it after that, and that's really something to take into the next week, Jesse, if you ask me, because if you can continue into a mindset that the equities markets is not going to go down anymore. I think with the retail market and the beef featuring that we saw this past week, and the fact that cash cattle were able to get back up to 126, pork cutouts not falling that much, you've got some support there in the livestock market. I'm still a hedger at higher levels in the cattle and in the feeders, especially if the corn turns around.
On the cattle side, I know we got the cattle on feed report this afternoon. Not quite out yet here. Don't have the numbers in front of us, but I know we're waiting to see what that looks like. And then you look at these cutouts just screaming higher here the last couple of weeks, Mike. And this futures trade and the cash trade really not moving a whole lot. It's kind of the same story we've had the last few months, honestly, last year. But talk about what you're seeing in cattle here as we wrap up this week.
Sure. The nice thing we saw in the cattle were the negotiated prices did move quite a bit. We were back up there around 126, 127. That equaled the futures prices or got us close to the futures prices. And we dearly needed that because we were building way too much of a premium on the board compared to cash prices at 122, 123. So I think we did what we needed to do. And I think that's because some cuts are becoming available. Some big grocery stores like Kroger this past week, they featured a lot more beef and a lot less chicken and a lot more pork and beef together. So I'm wondering whether the poultry market is letting in the beef here as we close out the summer grilling season. I think the big number for cattle on feed and to keep me on the hedger mindset, especially given this COVID issue we talked about during today's show, is that marketing's number. Range of estimates from Reuters was 95 to 101. What a range, Jesse. So if we're down around 95, that's a very negative number. If we're 101 plus, that means we're shipping it out, and this $1,000 ahead of packer margin that we're hearing about is really getting the business done.
And I heard a lot of cattle ranchers this week talking about that packer margin number, and
Bet
there's
you did.
definitely a fight brewing around that that's been going on here for a while now. But hopefully the cattle industry can get that figured out. Mike, any final thoughts you have for us here before we wrap it up for today?
I've always been in the mindset, Jesse, in commodities is stick with what's right. And, the dollar's been really good to us as far as pointing towards the trends. So watch the dollar. I will say this very plainly. I can't understand why the funds are buying the dollar, given what's going on in Afghanistan and with China and some of these geopolitical issues. And I'm wondering whether that dollar's got maybe kind of a leash on it as far as how high it can go. So be on the lookout for that.
And Mike, I know if producers want some advice with their marketing, they could reach out to you and check everything out. Global Commodity Analytics. I know you got the free trial on the website.
Yeah, globalcomresearch.com. That's the way to go to get the trial. I work with people that I talk to 4 times a day. I talk to people 4 times a year. It's all based upon what you want to do and how much communication you want. We're there to serve you. So please go to globalcomresearch.com, globalcom with 2 M's, and sign up for a trial.
Mike, appreciate you joining us here on a Friday. Thanks for being part of Market Talk, and we'll talk to you again next week.
You bet, Jesse. Get some rest.
Thank you, sir. Mike Zuzolo, Global Commodity Analytics, our guest today on Market Talk. That's going to do it for our Friday, August 20th edition of the show. I'm Jesse Allen, wishing you a great afternoon and a great weekend.